From Kansas State University, this is Agriculture Today. Thanks for joining us. Eric Atkinson here. And at the center of attention on today's edition, the 2018 Farm Bill. During our first half hour, K-State's Reid and Mykel Taylor will discuss the commodity title changes in the new legislation, focusing mostly on the safety net provisions in the form of the ARC and PLC payments. They'll highlight the new payment program flexibility that's now built in and the important changes in how the actual payments are determined, plus more with Mykel and Robin next. And further ahead, K-State's Charlie Lee looking at the features in the new Farm Bill that pertain directly and indirectly to wildlife conservation and management. All that and more coming your way next on this Agriculture Today.
What is radon? Home exposure to radon gas is the leading cause of lung cancer death in the United States for non-smokers. In Kansas, 1 in 4 homes will test at or above the EPA action level. The Surgeon General recommends all homes be tested and fixed if necessary. Visit kansasradonprogram.org for more information. Test, fix, save a life. This message brought to you by the Kansas Radon Program, the Kansas Association of Broadcasters, and this station.
This is the Tuesday edition of Agriculture Today. Thanks for being along with us once more. The first half of today's program will be devoted to some of the finer points of the 2018 Farm Bill as it awaits final signature from the White House. But the details in specific today on the commodity title, and even more directly from there, the price support programs are out there and for consideration. And our two guests have been crunching through the information from the bill and the numbers attached to it. Mykel Taylor and Reid are agricultural economists with K-State Research and Extension, and in the coming next few months they'll be out and about in Kansas visiting with producers about the options afforded to them. Let's start with you, Mykel. Just your observations initially upon what you saw in the 2018 Farm Bill in regard to agricultural risk coverage and price loss coverage. We know them as ARC and PLC. Some changes have been made here.
Some changes have been made, but generally we have maintained the structure of the ARC and PLC programs. You still have one that's revenue-based. You still have one that's price-based. We're still going to be working with, similar types of data, although we have changed some of our data sources from county yields and changed the calculation on reference prices and things like that. But generally speaking, we're still working with the same basic programs.
And Robin, your thoughts?
Yeah, I think some of these are actually fixes to maybe how it should have been 5 years ago when we went ahead and did the 2014 Farm Bill. I know the committee listened to a number of testimonies, and some of these changes I can see as a direct result to that. So hopefully some of these will be improvements to the programs.
What we'll talk about today, what is generally known, although there's interpretation on a great number of the specifics to be had on these, right?
Absolutely. We're still going to have to wait for the Secretary to interpret certain aspects of the legislation, and so we won't know some of the finer points of the legislation, but we do have some general ideas about how things are going to work.
Let's start with this, the choice between ARC and PLC. Robin, there's a little more latitude now in the next couple of years as to what producers can do with the coming of the new Farm Bill itself.
Yes, so there won't be the stress of making a 5-year decision, trying to forecast what might happen that many years out, but we will have more frequent decisions. So there is going to be a sign-up period this spring at some point to sign up for 2019 and 2020. They'll be making one decision per commodity, per FSA farm for those 2 years. Then starting in 2021, they will make annual elections between PLC and ARC for each commodity on their operation.
So producers will be able to, year by year, eventually analyze where the markets are, where production is, and really tailor that decision to their very needs. Mykel?
Yes, absolutely. There still will be some uncertainty about how those yields and prices will come out, but they will have a lot more information when they look at yields and prices and seeing where the market is as far as what looks like the better program to be in going forward, and being able to re-up on an annual basis is going to give them the most flexibility to be in the program that they want to be in.
Well, what we know about changes this year, the first things that come to mind, the reference price changes may be one detail that will play very heavily in all of this. Talk about that, Robin.
So the statute reference prices actually stayed the same. So if you remember in the 2014 Farm Bill on corn, that was $3.70, soybeans $8.40, wheat $5.50, and grain sorghum $3.95. But what they have now is what they're calling the effective reference price, and that looks at a 5-year Olympic average, so the last 5 years dropping the high and the low and multiplying that by 85%. Now, if that is higher than those statute reference prices that I just listed, that can set the reference guarantee. Now, that can only go up to 115%, though, so we can't have a huge effective reference price. But looking at prices the last 5 years, we know commodity prices have been low. Looking at that formula, it does not look like we're going to be seeing anything higher than those statutory reference prices unless our markets really pick up in the next 5 years.
So consider the statutory, the standard price is basically a floor price for the program.
Correct, yes. Those can't go below those values.
In addition to those added options for the reference prices, what else is within the ARC and PLC framework, Mykel, that would be new to producers?
Well, one of the things that we're looking at is the base acres that have been planted to grass or pasture or not planted basically to any of the program crops for the years 2009 to 2017. And what we're going to do with those acres is suspend them from receiving payments, but still consider them to be historical base for future legislative purposes. So those acres won't be eligible for the ARC or PLC payments, but they will be eligible for a CSP, grasslands payment of about $18 an acre.
We'll get into some conservation title matters, including the CSP and its new iteration here. There are some updated yield data options here in the new Farm Bill. Is that correct?
Yeah, so what I mentioned is they have to make a 2-year decision this spring for ARC and PLC, but they will also have to be making a decision or look at their numbers again in 2020 to see if they want to update their program yield for the PLC program. And that is just your established yield with FSA that's used to calculate your payments, have you choose the price loss coverage. But we had this update last time around, but we had a lot of areas that were having drought in their 5-year history, so they decided to go ahead again and offer the payment yield update. Now, the formula is just a little bit different than last time around in that they're looking at the last 5 years, but there's also a detrending factor. So what that is the average national yield from 2008 to 2012 divided by the national average yield from 2013 to 2017 for each commodity. So there's a ratio, and we can put those numbers out there, but most of them are between 90% or even 100%. So what you do is take your yield for the last 5 years. If you didn't plant in one of those 5 years, then it becomes a 4-year yield or a 3-year yield or whenever you did plant. There is kind of a plug yield that's used, and that's 75% of the county yield. So if you did have a catastrophically low yield, that does get replaced in your history. Then they calculate the average, and then they multiply that detrending factor. So that's a very complicated formula, but basically it boils down to if you can produce your yield history and run it through that formula and it's higher than your established yield with FSA, you'll want to update that payment yield so future program payments can be higher.
It'll be important to have a dialogue with your FSA personnel to sort through all of that intricate detail. And by the way, just as a footnote, in the language of the bill, the FSA will be required to publish the source of data used to calculate that county yield, along with the number and the outcome of occurrences, as it reads, in which that yield was reviewed, was changed, or determined not to change, as the case may be. What about payment eligibility? Mykel, there was some language in the bill addressing that.
Sure. So payment eligibility, the individual payment limit is remaining the same at $125,000, but the definition of family is being extended to nieces, nephews, and first cousins, and also the adjusted gross income cap is remaining at $900,000.
So it's really not a great deal of change there, with the exception of the extended family clarification in effect?
Correct.
And I will add to that, if we do get in a situation of LDP payments and marketing loan gains, they're now excluding them from the $125,000 payment limit. So there was kind of a workaround before to get away from that, but now those are excluded from the $125,000 limit.
Speaking of LDPs and marketing loans, what does the language in the new bill have to say about those features?
The loan rates have been increased for the Marketing Loan Assistance Program and loan deficiency payments. Corn is now $2.20, soybeans $6.20, wheat $3.38, and grain sorghum $2.20. So these are going to help if the farmer does want to put their grain on loan for cash flow purposes and market that actual grain later in the year. They will be able to get some cash flow from these loan rates.
One of the things that I think is just really important as we're talking about all of these different prices and formulas is that we are putting together a decision tool, an Excel-based decision tool that's going to have all of the default information in it and will allow producers to input their own information and come up with their own calculations. So I think it's really important to remember that K-State's going to try to support this decision-making process as much as possible so that you're not trying to do these on the, back of a sheet of paper and wondering if you're coming up with the right numbers or not.
And as producers hear what we're talking about today, they have to understand that there will be time to sort through all of this because so much interpretation, as you said, Mykel, is yet to be made on the finer details. So producers don't need to panic quite yet when they hear all of this, but rather be ready to study it further. Is that fair to say?
Yeah, that's fair to say. There's 60 days from the signing of the Farm Bill to getting out the data that's going to be used for these calculations. And then there will be a lag, I'm sure, of some period before the elections are made to give people time to process their decisions.
And, of course, there will be a list of the opportunities out there in the country to learn more about the programs. As we get into 2019, there'll be a schedule of meetings K-State Research and Extension will be putting on in that regard for you producers. There's more that we want to address in this area, and we will do so with our guests after the break, Mykel Taylor and Robin Reid, our agricultural economists with K-State Research and Extension. And Agriculture Today returns in a few moments with that here on the K-State Radio Network. Agricultural producers, landowners, and creditors, you have a partner in your legal and financial needs. Kansas Agricultural Mediation Services offers reliable, trusted information and guidance. Whether you need advice for ag credit concerns or are transitioning your operation to the next owner, Kansas Agricultural Mediation Services can assist you in making sound decisions for your business. To learn more, call 800-321-3276 or visit us online. We're back now on Agriculture Today and walking through some of the mechanics, if you will, as they're known to date about the commodity title of the 2018 Farm Bill, which awaits final confirmation out of the White House soon, but it's largely expected, and specifically to the ARC and PLC program options, plus more, though, as we rejoin our agricultural economists in studio talking about these matters, Robin Reid and Mykel Taylor, K-State Research and Extension with us. And sticking with the ARC and PLC payments, there was one important change that has to do with the data used for making these calculations, which shifts from one source to the other, right?
Correct. We're switching from National Agricultural Statistics Service data, which is gathered by surveys, to RMA data, which is gathered by the crop insurance reports that come in and certified yields. And so it's not clear to me that the one data source is all that much different from the other. For some counties, it will be very similar, and for some counties, it might be quite different. But one of the things that it does do is require USDA to get those yields out and published and available for people to see in a more timely fashion.
So there should not be a presumption that the data will be more representative, so to say.
Well, I think that depends on what county you're in and what crop you're talking about, because crop insurance is going to be really good coverage for some commodities in some counties, and then perhaps for other commodities it may be a little more spotty depending on what county you're in. There were pros and cons to both data sources, to be honest, and switching to RMA, like I said, the biggest benefit we have from switching data sources is just getting them out in a more timely fashion.
Robin, another change that has been at the epicenter of discussion and is now in the new Farm Bill, those ARC payments are to be calculated on a basis other than the county, rather on the actual location of the farm?
Yes, and this is something probably 5 years ago should have been the way it was, but what happened was they allowed the ARC County payment to be calculated based on where the producer administered from their FSA office. That went through the first year, and then all of a sudden they gave producers the option again to have their payment recalculated based on the physical location of the ground or the administration office. And then I think the following year after that, then they had to pick which one they wanted. So the Farm Bill language this time around 2018 specifies that the payment for ARC County will be calculated based on where the land is physically located, not where they administer their FSA office.
So does that alleviate the issue by and large, hopefully?
Well, hopefully will not be a point of contention this time, because there was even, I've been getting calls after these last payments went out that if they had been paid where the ground actually was, their payment would have been higher. So it just eliminates an unfair calculation in my mind.
For years 19 and 20, as you two look at the information, which looks best for the producer? But that's a loaded question, understood, because there's no definitive answer. But can it be speculated as to whether one or the other will be more favorable to grain producers upcoming?
It is anticipated nationally that there will be a lot of switch from the ARC County program to PLC. And one thing we haven't talked about, there is still the ARC individual option. So let's not rule that off the table. There was some sign up in that and maybe some success in that program in the last 5 years. So something to still kind of think about. Going forward, I think there is definitely value in looking at the ARC County guarantee and comparing that to the PLC reference price, because as we're switching to RMA data, that yield history will change. How they're setting the effective reference price has changed. So knowing what yield it would take, what price it would take to trigger a payment in your county is still very much something you should think about before signing up for PLC or ARC County.
And that calculating tool you talked about, Mykel, will be immensely helpful in this respect.
Absolutely. It'll help you make that comparison between the two. And like I said, we'll provide as much default data as possible so that people don't have to go hunting for the information, but that instead you can come to K-State and Ag Manager and find what you need in order to make that decision as best as you can.
And that'll be out in early 19 with all hope and luck.
As the final interpretations are made on the current legislation, we will tweak that tool and get it out as quickly as possible.
Very well. Well, just a brief mention here of the crop insurance provisions within the Farm Bill language, and drawing directly from the summary that you two have put together and have made available to folks now, the crop insurance title seeing very little change, a relief to most producers who consider that their number one risk management tool. To note, enterprise units are now allowed across county lines, and another change involves how cover crops are handled, and that may increase the use of cover crops in some areas. Also mentioning that approved insurance providers will be required to submit producer yields 30 days after the final reporting date. That'll hopefully speed up the process of publishing that county yield value and will allow producers to estimate an ARC payment for cash flow purposes. That could be particularly helpful for wheat, meaning that the yield and the price for ARC should be known by July the 1st. That would allow producers as well as lenders to have a solid estimate of their ARC payment for wheat several months before the end of the marketing year, June the 30th, for wheat. So again, subtle but important modifications to the crop insurance language in the new Farm Bill. Mykel, you're the designated guru on the conservation title within this room. So share a few thoughts that you have about what's there in regard to Conservation Stewardship Program. It's being rolled over into the EQIP program. What things do producers need to be aware of within that conservation title?
Well, a couple of things. As far as the Conservation Stewardship Program is concerned, any remaining life on the 5-year contracts that have been signed will be honored, as I understand it. So it's not like that program is just going to stop all of a sudden. It'll be phased out slowly as those contracts expire. And then, as opposed to having that being a standalone program, they're going to roll that into EQIP and have EQIP be the preferred program for paying farmers to do conservation practices on their ground. The other thing that's going to happen is CRP. The acre cap is going to be increased from 24 million acres currently to 27 million acres by 2023. But rental rates are going to be reduced to 85% of the average county rental rate for general signups and 90% of the county average for continuous CRP enrollment. So we had a lot of CRP ground get kicked out of the program because of the acreage cap and also because of the rental rates that we had on that ground was really high. So they're making an adjustment which will allow us to get more acres back into CRP at probably what is more relevant as a market price for those rental rates.
And that was the question. Is there incentive there given, well, the present state of grain prices to see more commitment to conservation program options like CRP?
Well, I think especially for ground that was kicked out of the program over the last couple of years, one of the problems with it is that it's expensive to get it up and going into other forms of, production ag, whether it's if you want to graze it, you're going to have to put up fence, get a water source, so on, or to break it out for farming. And it was never that great a farming ground to begin with. So I think if there's an opportunity to get it back into CRP for some of that ground, that's going to be the best usage for it.
All right. Well, Robin, producers have time during the winter to contemplate a great deal of this. How would you advise they go about looking into the finer points of the Farm Bill, the commodity title in particular, and brief themselves on what's going on and sort of orient themselves toward it?
Well, at this point, I don't think I would lose sleep because, as we have said, there's going to be some lag time here as the Secretary interprets the law and decides how that is going to actually play out in the counties, training FSA staff, and then, announcing the sign-up period. Unfortunately, that may come about the time we're trying to get out in the fields this spring, but it will be a long enough period that there will be time to think about the decision, look at the data for your own county, and decide what program would be best for the next 2 years. And like I said in the beginning, hopefully there's less stress this time around because it is a 2-year decision and then an annual decision after that. So hopefully these programs will really help our farmers that are struggling out there with the lower commodity prices.
And Mykel, in closing, you and Robin have put together already, being proactive on this, an article on agmanager.info that digs into the basics of several things we've discussed here today, plus more, right?
Yes, gives you some details on some of the changes that were made versus the 2014 Farm Bill. And we will keep updating information on Ag Manager as we learn more. We continue to get questions rolling in from around the state, and we're just trying to get as much information on to answer those questions as we can. But we will keep people informed as we learn.
What you're looking for on Ag Manager right now is this article. It's entitled A First Look at the Agricultural Improvement Act of 2018. Farm Bill 2018, if you prefer. Have a look at that information at agmanager.info. And thanks to the both of you for sharing all of this with us right here.
Thank you, Eric.
You bet.
Mykel Taylor and Robin Reid with us from Research and Extension Agricultural Economics here at K-State, and some of the details of importance out of the 2018 Farm Bill, with particular respect to the commodity title and the safety net, if you will, in the form of the ARC and PLC programs. This is Agriculture Today. Now this break, we'll return with today's agricultural news headlines plus more here on the K-State Radio Network.
Hamburgers, roast, ribs, steak, or whatever you prefer. Beef, it's what's for dinner. Kansas cattle farmers produce 7.5 million head of cattle per year. It takes about 7 tablespoons of peanut butter to get the same amount of protein in one serving of lean beef. Support your local Kansas farmers and ranchers. Eat beef. This message was brought to you by the K-State Animal Sciences Leadership Academy participants.
Broadcasting from the campus of Kansas State University, this is Agriculture Today. Eric Atkinson here. And next up for you, today's agricultural news headlines. These courtesy in part of DTN. Well, the USDA announced yesterday afternoon that the second and final round of trade aid payments under the Market Facilitation Program will be issued. Producers who grow commodity crops will collect a second payment based on 2018 production. The USDA, though, did not make any changes to the payment rate that had led to some complaints by some commodity organizations, including the National Corn Growers Association, because corn producers received a cent per bushel on trade mitigation payments. There were doubts raised last week about the payments after USDA officials noted delays in approval of the second round by the White House Office of Management and Budget. USDA Secretary Sonny Perdue went to the White House last Friday to speak with the president on those payments. The USDA's Gary Crawford picks up the story from there.
You may remember last Thursday, Agriculture Secretary Sonny Perdue told reporters he expected the second round of trade mitigation payments to be issued, as he put it,
very soon.
And Monday afternoon, he did announce the launch of that second round of payments, although he said he did have to convince the Office of Management and Budget in a Friday meeting to let the payments go. The original idea, of course, was that the second round would not happen if tariffs eased and damage to farmers was lowered. Perdue said,
from my perspective, that it's not the case just yet. We still even have the retaliatory tariffs between Canada and Mexico, which we are working feverishly to overcome.
So round 2 is being launched. According to the chart issued with the announcement, the soybean payment remains at $1.65 a bushel. The corn payment rate is still 1 cent a bushel. For more information, contact your local USDA Farm Service Agency office. Gary Crawford for the U.S. Department of Agriculture, Washington.
Now, sign up for the MFP began back in September. It'll run through this coming January the 15th. You producers must fill out an application by the 15th, but you have until May the 1st to certify your 2018 production. Payments will be based on reported production and are projected overall to top $9.5 billion. As of yesterday, the USDA had distributed $2.3 billion, indicating that there are a lot of producers who have not yet enrolled for the program or have certified their production on their 2018 crops. Under the formula, the USDA set a value per bushel that was affected by the lost exports to China and other markets due to tariffs. The price per bushel then divided in half. For instance, soybean losses at $1.65 per bushel. The first round of payments at 82.5 cents a bushel. The second payment will be valued at 82.5 cents a bushel as well. Soybean producers expected to receive nearly $7.3 billion in payments, or more than 3/4 of the total MFP payments. U.S. pork exports are up, and price may well be one reason, according to a USDA analyst. Here's more from the USDA's Stephanie Ho.
World Ag Outlook Board Chair Seth Meyer calls 2019 a pork trade story.
We jumped kind of into the export market. We got beat up a little bit earlier on for the export number that we were running after all the tariff talk, and it had been our assumption that it's not the quantity that'll be hit, it'll be price. So price will do the work to bring that market into equilibrium. And in fact, it has.
In its latest report, USDA raised next year's pork export estimate.
We've got continued strong global demand. Price is doing the work to get it out the door. We're competitively priced into certain markets, and demand has been good at those prices.
He says there is expectation that prices for hogs in 2019 will increase $1.25 to $42.75 a hundredweight.
None of this is related to any of the discussions in China. I mean, we've been doing gangbusters to places like Korea and some other markets.
He hopes that once these markets get a taste of U.S. pork, the sales will continue. This is Stephanie Ho for the U.S. Department of Agriculture in Washington, D.C.
And up now on Agriculture Today, this week's edition of Milk Lines with K-State dairy specialist Mike Brook. Mike?
Today I went to visit with our Kansas dairy farmers about navigating some of the forage issues that we're starting to see as we move into the 2018 crops. I've received several phone calls, and many people are wondering how they can get a little more milk out of their cows. Part of this is driven by where we're currently at with milk price, obviously, but part of it's also, as we've switched over to the 2018 forages, we've seen a drop in milk production in many herds. So as we break this down and start to look at the reasons for that, there's several different factors that we have to consider. First, we did have a drought last summer over most of the growing area here in Kansas. That actually has two negative impacts on intake as well as milk production. The first one is what happens to fiber digestibility. Just as your cows suffer from heat stress, your crops also do as well. And as they suffer from heat stress, we do see an increase in the amount of ADF and NDF fiber that we find in those forages. In addition, the digestibility of the NDF fiber is generally reduced. Again, this is just a response to the stress that the plant endured. A second factor that we have to consider is that much of the corn silage that was harvested probably did not contain as much grain as normal, and in fact, in some cases, it did not contain any grain at all. So, we also are missing the starch that we normally find in our corn silage. So, as we start to consider how this impacts our cows, we got to keep in mind a couple of things. Number one, dry matter intake is really a key factor in helping animals get to higher levels of milk production. Every 1 pound increase in dry matter intake generally results in about 3 pounds of additional milk production. Now, here's the problem. With higher fiber contents and also lower fiber digestibility, our actual dry matter intakes in our herds are probably off a bit from what they have been in previous years. A lot of times we'll be looking at maybe 2 to 3 pounds lower dry matter intake due to simply the lack of fiber digestibility and increased fiber contained in the forages that we're feeding this year. So what can you do to combat this? Well, this is a very difficult question. As you work with your nutritionist, there's a couple things you can consider. One way is to increase the starch level of the diet. Again, we have to stay within a range that is safe for your cows, but increasing the starch level 1 or 2 points may be a way to get a little more milk out of the cows, as well as maybe a little additional dry matter intake. The second thing you can consider would be some alternatives to some of the forages that you're feeding that might have issues with fiber digestibility, as well as fiber quantity. So, switching to some of our byproducts that have high fiber contents and low starch, such as wet corn gluten feed, could be a possibility to increase dry matter intake and reduce the dependence that the animal has on some of these poorer quality forages. This is Mike Brook with K-State Research and Extension.
Thanks, Mike. And you're tuned to Agriculture Today.
While many people know hunger is an issue in developing countries, it is also a problem in our own backyards. In 2010, 1 in 7 Kansans struggled to put adequate food on the table. 2 K-State Research and Extension programs are tackling this problem. The Family Nutrition Program and Expanded Food and Nutrition Education Program reach thousands of Kansans in more than 70 counties. They learn how to eat healthy with a low budget. For more information about these programs, visit ksre.ksu.edu.
Agriculture Today is back now, and we're visiting once again about wildlife management with K-State Research and Extension Wildlife Specialist Charlie Lee. Charlie, continuing on today's theme on the broadcast of the implications of the 2018 Farm Bill that's passed Congress now, awaiting the President's signature, the conservation provisions within that legislation of importance to wildlife, and those are rather far-reaching, aren't they?
Yes, I think it would be very difficult to really, truly understand how important Farm Bill funding for conservation provisions is. When we look at past conservation programs and their impact on wildlife, we can very clearly explain some of the increases in conservation that have occurred directly because of those conservation programs. I think this 2018 Farm Bill, if it's signed by the White House, is very similar to some in the previous versions. It shows steady incremental improvements in the conservation programs. One of my priorities was to make sure that there were no cuts in conservation funding, and this one appears to hold the line on the dollars. Some of the early discussions was to be about $800 million cut for conservation programs. That could have been devastating, but that didn't occur. I understand the legislation takes compromise, and I believe that in this case compromise was certainly important to get all of the improvements that we're going to see out of this Farm Bill.
Let's break it down into the various features then within the Farm Bill that are significant to wildlife conservation. The Environmental Quality Incentives Program, a particular here, is reinforced in this bill.
Yeah, the EQIP, as it's known, has increased from 5% to 10% of those dollars are going directly for wildlife habitat. Previously, it's only that small amount was for wildlife-friendly practices. Much of the wildlife funding within EQIP goes in large part to working lands for a wildlife program. That certainly played a role in protecting some species from being placed on the threatened or endangered species list. I understand that there's about $60 million a year currently spent on wildlife practices. With a higher funding level, I think we'll get more money that's dedicated to wildlife practices. And farmers and ranchers are going to be able to create wildlife on their lands previously not been able to as a result of lack of funding. Keep in mind that most of these Farm Bill conservation programs are voluntary, and they're very popular, and not everyone gets enrolled as they're oversubscribed. The increase in funding will allow, I think, more habitat practices to be placed on the ground.
All, of course, are familiar with the Conservation Reserve Program and what that has brought in the way of wildlife habitat availability over the many years. And the acres for CRP have been hiked as well.
Yeah, this Farm Bill expands the Conservation Reserve Program by 3 million acres. That's up from 24 million acres in the last bill. CRP may be the most important land conservation program that we've ever had. We've certainly documented and discussed many times the wildlife improvements that we've seen as a result of previous Conservation Reserve Program lands, and I think this will only allow more people the opportunity to participate in Conservation Reserve Program lands.
Well, CRP, EQIP, among the more high-profile programs out there, but the bill addresses some other equally important matters, including the control of invasive species in habitat.
Yes, I think that's important that we've recognized in the Farm Bill that invasive species management is important. It dedicates some funding to invasive species management, including feral swine eradication. With Kansas deer seasons about to close and the heightened awareness about chronic wasting disease, I was excited to see the Farm Bill mention research in chronic wasting disease, making that a high priority. There will be some funding allocated for that, and I think that's another area where we've got to get on top of things before it becomes too late. Another provision there that probably won't get a lot of exposure is that USDA must adapt quickly to new science and technology changes. They've given NRCS a one-year window to make sure their conservation practice standards reflect new technology and science. I think many of those are outdated and will require a very thorough review to make sure that the science on which the implementation of many of these conservation programs is based is up to date.
One other area that needs to be mentioned within all of this, and that is wetlands provisions, coupled with that water quality initiatives, once more with relevance to wildlife resources. What does the bill say about those?
Well, the wetland conservation provisions are largely remain intact. The swamp buster is still in there, so we've got conservation compliance and crop insurance subsidies still tied together and linked. It actually rebuffed a lot of attempts to weaken wetland protections. I think our wildlife is certainly going to see a response to continuing efforts to improve and protect wetlands. It's difficult for some folks in Kansas to understand the importance of wetlands. They're certainly very vital for many, many species. You may not see those species, but wetlands are of a tremendous importance even here in the heartlands of the United States.
So in sum, quite a bit of content in the Farm Bill that will be of significance to wildlife management, wildlife resource preservation from here forward.
I expect good things to come out of this Farm Bill. As we've known for many, many years, it takes a lot of dollars, and those dollars usually have to come from the federal level. We can do a lot with state program dollars, but those funds are really insignificant in comparison to the dollars that are available through the implementation of federal conservation programs. With the thought that goes into these programs, the discussions, it seems that this Farm Bill has done a good job of providing some of those incremental improvements that previous Farm Bills have set forth.
Well, Charlie, we appreciate the observations right here, as this has been a quick review of the wildlife-oriented features within the 2018 Farm Bill. Charlie Lee with us, wildlife specialist with K-State Research and Extension. With that, our Tuesday edition comes to a close. Thanks for tuning in. Please rejoin us this same time right here tomorrow, won't you? Meantime, Eric Atkinson bidding you a good day for Agriculture Today. This is the K-State Radio Network.